Okay, let's take a look at exercise 10-14B. So in this case, Freight Company issues bonds of $300,000 face value on January 1, year 1. Bonds had a 6% rate of interest in a 10-year term. Interest is paid in cash annually. The bonds were issued at 98, and they used the straight line method of amortization. So in that case, the important things I need to know are $300,000 here. It's a 6% rate of interest, 10-year term, and it was issued at 98. So that tells me that we're going to, that this was issued at a discount. So we're going to need to figure that out. So the first thing they ask for is to do a simple transaction grid like we've been doing to show what goes up and what goes down in this case, both for when we issue the bonds and then later when we make the first interest payment. So when we issue the bonds, cash is going to go up, bonds payable is going to go up, and we're going to create this bond discount account that's going to have a negative balance compared to the positive balance of bonds payable. Okay, so in this case here, we would have $300,000. It was issued at 98, so at 2%, so it should be a $6,000 discount. So this will go up by 300, and that will be a negative 6,000. Then when we make our interest payments, cash leaves our business, so cash goes down. We reduce that bond discount account because it's a negative balance. We decrease it with a positive number, and then we record our interest expense. And we'll do that each year for the whole period of the bond. The next thing they ask for is what is the amount of interest expense on year 1 of the income statement? So in order to determine that, I need to find out what the amortization of that bond discount is going to be, because that's going to influence the interest expense. So in this case, the bond discount, 300,000 times 0.98 is 294. So 300,000 minus 294 is 6,000. That's the amount of the discount. And we're going to split that into 10 chunks because this is 10 years. We're making annual interest payments. If this was semi-annual interest payments, then I would have 20 periods I would spread it over. I'm going to spread it over the number of times I'm going to pay interest. Okay, so that gives me $600 for each time I pay interest. So the interest expense is going to be what I pay. And I'm always going to pay interest based on the face value of the bond, regardless of whether I get more or less money for it, and the interest rate on the bond. So this is an annual, so I don't need to multiply by 12 over 12, but I could. So 300,000 times 0.06 is 18,000 plus the $600 amortization. So I'm going to add the impact of amortizing the bond discount to my interest. If this were a premium, it would go the other way. I would subtract it. So I end up with annual interest expense of $18,600. The next thing it asks me for is the carrying value. So the carrying value is the face value of 300,000 plus or minus any unamortized discount or premium. So in this case, my bond discount started out at $6,000. Excuse me. Sorry about that. So in this case, it started out at $6,000. So my carrying value to start off with was $294. That will increase as I reduce that discount. It'll get closer to $300,000. So the carrying value is $294,600. It's $300,000 minus the remaining discount, $6,000 minus $600. The second year interest is going to be the same as the first year. And then in the second year, the carrying value at the end of the second year is going to be $300,000 minus the unamortized discount. In this case, it's the original $6,000, and I've made 2 amortizations of that discount, so $600 and $600. That gives me $295, $200. So hopefully that makes sense. You could follow this pattern, and then also take into account there's another problem you'll do where they pay semi-annual interest. Just take into account that that's double the number of periods. So hopefully that's helpful. If not, please email me, and I'm happy to help you. Bye-bye.